She joins us in studio as well. Lesley, thanks for coming in.
Good morning, Paul.
I'm interested in the fact that you and your colleagues at Mackenzie have recently downgraded your weighting on stocks from an recommended overweight position in stocks to a neutral weight. Talk to us about that decision.
That's right. Within our Global Investment Committee, we met recently to discuss the potential impact of tariffs on equities overall. We had an overweight position towards equities for balanced portfolios. And we just felt that the market wasn't really pricing in the additional risk that tariffs could bring, for more short-term dislocations and potential for future inflationary forces. And so we felt that this was the right time to go neutral with our equity allocation.
And does that include equities in Canada and the U.S.?
It does. It does. So overall, we reduced our overweight to equities. We had been favoring U.S. equities. We were neutral to Canadian equities. So now we've moved that U.S. perspective to neutral.
And how would you characterize the risks of tariffs? Are they a threat to economic growth? Are they an inflationary threat? Are they both?
All of the above, yes. I think very much so. I don't think you could find an economist on the planet, other than those that are advising President Trump right now, that wouldn't say that tariffs create inefficiencies, dislocations, potential for higher prices, and therefore a slowdown in economic growth. The reality is that despite the fact that the agenda is very much set to utilize tariffs to help finance tax cuts into the future, which may make some sense because you have to finance those tax cuts somehow. The ability to adjust a supply chain in the short term is almost an impossible task, particularly in the manufacturing sector. So there's just no way, and even President Trump himself has admitted that there could be some short-term pain as a result of tariffs. And the other thing is we're in the cycle of uncertainty, this 30-day reprieve. Oh, now we have tariffs. And so just this idea of a little bit of chaos that's created through the uncertainty of the outlook for the impact of tariffs has made us a little bit more cautious on equities.
And you don't think equity markets are currently pricing in this particular risk, correct?
No, I don't. And I think actually, and I've been thinking a lot about this, I think the reason is that we've seen so many instances over the last month or so, it's not even been a month, where you've seen the threat of tariffs and then a pullback on that threat. Right. And so I'm thinking that the market is maybe thinking that there isn't sort of substance to these threats, and that ultimately we won't see a large overriding tariff policy. But I think that's the wrong assumption to make, because as I said, really the alignment here is about financing tax cuts. So that financing has to come from somewhere. So I do think that tariffs are going to be part of the equation. It's just a matter of how big, for how long, and who is targeted.
That's interesting, because you're quite correct. I think most people believe that this is a negotiating ploy and eventually it will fade away. You don't think it's going to entirely fade away. What do you think the consequences are to the Canadian economy if we do get durable tariffs, lasting tariffs of some magnitude?
So I think certainly the impact to the Canadian economy is decidedly negative. I think there's downside, and this is in the face of an economy that is already struggling with growth. So I think the central bank will need to act quite decisively with monetary policy to reflect the slowing Canadian economy and the risk to the Canadian economy. But on the other hand, as we've seen, this is really putting Canada in a very focused position on what Canada needs to do to be much more independent from the U.S. And we're starting to see some really positive narrative coming forward around how we can invest in this country and really generate economic self-sufficiency. And we certainly have that potential. So the medium to long term for Canada looks very bright, but the short term looks a little bit uncertain.
Okay, after all of that, what sectors of the stock market should investors perhaps be moving towards?
Well, I think investors in some ways have sort of got this part right. And you've really seen the focus very much on a couple of areas. One, I would say the services sector. sector. The services sector is much less impacted, certainly from a manufacturing tariff outlook. So I would say the service sectors would be very important. So that would be like technology, for example. Also the sectors that benefit from the weaker Canadian dollar. So the commodity sectors where commodities are priced with global pricing mechanisms and very much in U.S. dollars. Canadian companies that produce here in Canada would very much benefit from the weaker Canadian dollar, even if in some cases they're subject to increased tariffs or a declining export market south of the border. There are other areas of the world that we can certainly ship our goods, and we'll be looking to do that for sure. So those would be two examples that we think sectors that will do quite well in this environment.
Lesley, thank you.